Thanks for joining us in between the AI and the crypto conversations, real estate. So probably more in your portfolios than those. But my name's Jim Bowles. I've spent the past 25 years in the asset management business, really focused on the new business and relationship management side. I spent 3 years at Prana Investments. They focus on rent stabilized multifamily, and prior to that, 25 years at Common Fund, a nonprofit asset management shop. So I'm delighted to welcome you to the Real Estate Outlook 25 panel discussion. The real estate sector has always been a dynamic and critical component of our economy, influencing both individual wealth and global financial trends. As family offices, you're navigating a real estate market that's undergoing significant changes with questionable interest rate changes, a wall of debt maturities, and evolving sector dynamics. There's both uncertainty and opportunity. So to help us with the risks and opportunities ahead, we have an esteemed panel of industry experts who bring a wealth of knowledge and experience to the table. First, we have Ron Davari. He's the CFA. He's the Chief Executive Officer and co-founder of NewOak Capital. He has over 30 years of experience in credit and capital markets, and Ron is a highly respected figure in the private credit, private equity, and structured product arena. He focuses on the evolving needs of investors and borrowers in a complex financial landscape. Is Adam on the line? Adam Gower, founder of the Gower Crowd. Adam is a pioneer in real estate crowdfunding, which helps sponsors raise capital from high net worth investors. His insights into the democratization of real estate investments are invaluable in understanding the future of funding in this sector. And finally,
was Adam here already?
I don't know. Is he not here?
Keep on going.
Okay. And finally, James Malone. James is a managing partner of Assured Realty Capital and a senior managing director at Chesterfield Farthing. With over 25 years of experience in real estate equity and debt transactions, James has a deep understanding of market trends and intricacies of the real estate finance. So today, with our panelists, we'll explore the capital markets, financing challenges, risk management, sector-specific opportunities relevant to family offices. I want to begin by asking each of our panelists to share a brief overview of where they focus in the real estate market and spend a couple of minutes on what opportunities they currently see for investors, as well as areas of potential concerns. So why don't we start with James, go to Ron and Ron.
Thanks, Jim. I'll start by saying I see my name listed twice, so I guess you're getting the real version and the AI version of me today. So hopefully they're consistent. As Jim mentioned, I have roughly 25 years of experience, direct investments, covering a number of different investment strategies in real estate, national scope. And I currently serve as senior managing director of Chesterfield Farthing and managing partner of Assured Realty Capital. What we have done at Chesterfield, it's essentially a merchant bank, real estate focused, and we've been investing as principals in a variety of high yield strategies for upwards of 12 years. And that ranges from preferred equity, sponsorship capital, buying pools of performing and non-performing debt, and essentially seeking out high yield strategies across the real estate universe. One of the things that we've noticed and have really embraced for the past 7 or 8 years, I would say, is small balance preferred equity in real estate. And by that, I mean, our checks are typically $1 to $5 million. We're investing in sub to middle market sized assets across a variety of property types. And the idea came to us sort of organically that we were providing sort of transitional capital for some of our capital markets clients, and did quite well with the strategy, and realized that there is this inherent, almost structural impediment to sponsors who are seeking equity, less than, let's say, $10 million. It's a very, very hard check for them to raise. A lot of these sponsors are not well versed in capital raising, and it's just a space that is just not very efficient. The institutions don't play with these small checks, and we found that this is space that where it's an impediment for the sponsorships, it's actually an incredible advantage for us. We've delivered consistent 200 to 500 basis point excess returns to our investors by simply being in this small balance space where it's incredibly inefficient. And yes, there are unique factors. Your sponsorships are generally not as deep pocketed. They're not necessarily as experienced as you go up the capital chain. But really, for taking that risk, we feel we've been overpaid in a lot of instances, and I think our track record is very, very strong. We essentially have built a business at Assured where we are focused on this sort of niche strategy. Again, it's not served by dedicated capital providers. We are unique in our focus. We do think that differentiation creates excess returns, and the idea is really for us as a firm to scale this. We've done about 60 million in high yield transactions, and we think that with the right capital partner, this could eventually be roughly $250 million venture. At that point in time, it's very likely going to be an institutional joint venture or fund. We could obviously employ leverage to boost those returns, but we're talking right now with this strategy where we're getting 15 to 18% returns for pref equity unlevered. And that's usually split as a current return, which we pay monthly, and that could be anywhere from 8 to 10. The balance is the accrual. As I said, it's going to have a certain premium over what you would find if you're investing in larger pref equity transactions. And so obviously we're getting to the point where we're in this market, we're delivering a pretty strong equity returns and yet have control rights within our structures, not taking, significant last dollar exposure, and obviously have a defined duration, which is typically 36 months or so. We do add runways for our deals so that if the business plan is taking a little bit longer to execute, we give the sponsorship additional runway so that they can fully execute the business plan, and that helps our exit, obviously. But that is really what I focus my efforts on. We see that this business, again, it's really underserved. You do have to build the right mousetrap. Obviously, it's a lot of deals to get up to $50 million. So there are, inherent inefficiencies, and the key thing is obviously scaling. So that's really the evolution of my firm, is to scale this up to ultimately, bring in some committed capital. We do raise money currently on essentially a deal by deal basis, where we have high net worth investors and a New York City based family office. But in order for us to scale this platform properly, it's going to take, essentially a joint venture partner or committed capital that can allow us to properly scale up.
Great.
Good afternoon. Can you hear me? We're a multi-asset class, a specialty finance, special art, and private
Want to
equity.
hold it closer here.
This way?
Yeah.
Oh, great. Specialty finance, structured products, and then coming down to now very large developments in renewables and renewable-driven investments and operating assets that are stationary. Data centers fall into that, storage falls into that, and obviously hospitality as well. So within this space, we, generally speaking, work with, let me tell you some of the things we started. My very first start in the business in structured products had to deal with early CM buses in 1996. When this sector was just coming to fruition, we took a deep dive approach to individual loans. We went down the credit. We created the very first credit default swaps on actual down the credit, including some of the residual assets down below. And then obviously came into the space when we were on the short side. This is all my BlackRock history, but my desk. And then we went into creating opportunities in the distress in the residential mortgages. Some of you guys are familiar with PennyMac. PennyMac is now a $5 billion vehicle. Went on to being very first players in the flipper area where people were buying, boatloads. We actually had our own mortgage modification platform at NewOak. And then went on to analyze, I think, majority of CMBS space for some of the largest players, loan by loan. So we learned a lot from history. And 2015, we started Super Jumbo Mortgage. This is actually the last month of that vehicle. We're returning the expected returns on 5 million plus homes, 2 million plus loans, and the largest was a $10 million loan. That was the last one that paid off at 12%. Love that. And then recently came across emerging market, developing countries, India, where we're now creating a facility for build to sell for one of the highest end residential developers there. Looking at a very large, I think it's almost 4 square kilometer land in island of Sal in West Africa, which is, if you haven't been familiar with that, please take a read. It's considered by World Bank study one of the most desirable places to have an all year round 75 to 85 no hurricane experience that you would otherwise have in Bahamas. And now recently moving on a similar property arrangement in Dominican Republic. So in all of these things, we work with the land owner. We bring in the proper development, and then we start essentially do what related to somebody like that do, but more for specialty asset classes. Our experience in trying to lend on cannabis didn't go very far because we couldn't really close a single loan. So it was just tough to do that. So I would not say that we're financial engineers at heart. So there are a lot of other asset classes that we're looking at. Fintech is really our biggest bet, and you will hear in next couple of weeks probably an announcement that we'll be teaming up with one of the largest capital provider on the data centers globally in the AI aspect. We think that's an asset class that it's going to be growing. And is it real estate? Is it AI? Is it high-speed computing? Is it renewables? Is it finding cheap power in Ethiopia at 1 cent per kilowatt? These are all added value ways of doing added value. So we're not your typical, go for a multifamily or go. I mean, we like industrial, but industrial in the sense of converting that to maybe a factory for solar manufacturing, something like that. So real estate is obviously a big component, but value add to that is a big deal.
Thank you. Adam,
I don't have Adam.
don't have, okay.
I sent a note to him, but
Great. A couple of questions. James, financing challenges that made it difficult to execute deals. How are investors structuring transactions in 2025, and what creative financial solutions are?
So if you start with the thesis that, investors are seeking the greatest risk-adjusted returns, and you look at the activity in the market in the last 2+ years, where there's been a pretty significant deleveraging cycle happening. Investors have poured money into senior debt. There's been a lot of private debt funds that have entered the space that are now starting to gain real traction. So we see, for 2025, it should continue to be a more credit-focused strategy for a lot of investors. Obviously, there's ample capital that is starting to be deployed in terms of senior secured debt. And then as a subset of that, and what we do is preferred equity. So we try and fill some of the gap that traditionally equity investors, typically LP investors, have filled. That business has struggled, particularly when you get into the middle market space, where a lot of deals were funded through syndications, and those investors are now tapped out. They've been burned. There's just a real hesitancy to commit their capital going forward, at least for now. So certainly, a debt-focused strategy is really where we see a lot of capital being deployed. And you can get creative within this space. I mean, what we do, certainly, where we provide, to our investors equity-like returns for, essentially a kind of a hybrid debt structure where we have control rights and we have collateral behind us, so we're never taking sort of last dollar exposure. So I think that's really where the creativity is coming in, and you can go even beyond that. When you look at if you have real conviction in an asset, you can invest preferred equity, and then you can try and get a piece of the GP. You might have to give up some of your control rights, and you're taking more duration risk because you're going to probably be in the deal 5 years versus 3 years. But that's a way to enhance your returns if you believe that fundamentals in the business plan are sound and valuations have bottomed. Then I think that's a creative solution for investors. But we still see a pretty attractive runway for these kind of sub sectors, preferred equity, mezzanine financing, and then certainly senior debt. If you're looking to take that uncertainty and volatility off the table, or at least manage it better, then senior debt is certainly still very attractive. With these debt funds, they haven't deployed a tremendous amount of capital yet. They will, and once that starts to happen in a meaningful way, you're going to see spread compression. But right now, really the credit strategy is where we think is the best place to put your money.
Thank you.
I agree. I mean, really, right now, it's all about getting protection and upside simultaneously. So, or at least have the exposure to it and be ready to own it if that becomes a choice. And that's, but I don't think the cycle is going to be as dramatic as what we saw in 2008. So we saw a lot of interesting stuff happening in 2009, 10, 11, and opportunities came and got evaporated in a nanosecond. So I think there is definitely a big challenge when you are seeing returns in growth aspect in private equity in monies people are making crypto, and that's taking a lot of capital away from your traditional commercial real estate assets. So you're not seeing people jumping on that as much as getting excited, let's say, about putting money down for let's say, a data center which has a Microsoft, 20, 25 years, guarantee of taking the output. So, that you get safety, you get return, you get carbon credit, all sorts of things in that asset class. Again, I think there's a lot of discussion about, great wall of, debt coming down. It's going to be a lot milder than what we saw back in 2008. So be ready for, opportunistic guys come in, wipe that out, and we have to go back again, being able to buy that stuff at a more normal rates. I think the mezz and, asset-based lending and transitional properties is still a very, very good strategy because you get to have a short duration, have a lot of visibility in terms of forward sale, and if you're excited about emerging markets, there's quite a bit going on, I think, in India and growth of India, and with the Trump administration getting closer to India, I think we're going to see, that growth is definitely going to be in mostly residential space because you may not know about 80% of new construction in India is primarily in residential. You would think, yeah.
Yeah, so I have a couple of questions. So Ron, you're like the guy when it comes to, CMBS and things like that, credit derivative swaps, right? So you're saying that what you're seeing coming down the pike is not like 2008. And is that because there's more ability to control it on the government side, or the banks have less exposure, or, or it's not going to hit suddenly? That's my first question. Second question, what do you think about this kind of catastrophic scenario that's going on in Florida with apartment buildings or condominiums, where I think I read 1,400 buildings in Florida are uninsurable right now?
Yeah, I think that's one asset class that I'm not sure whether people want to jump in front of, right? And so, when you get into uninsurability aspects, is permanently distressed, right? And, unless you really have a way of getting Lloyd's of London or some group coming in and writing that insurance for you. But in terms of
So just to clarify, the status of being uninsured also means you cannot get mortgages
nothing,
on any of the properties inside those condominium buildings, because no bank will provide a mortgage because of uncertainty.
well, if you already have given mortgage, the current owner is not gonna unless
Obviously, you're grandfathered, but if you try to sell it, it's problematic.
well, you're not necessarily grandfathered, that you're technically in default. You are required to have property insurance as a borrower, but can they enforce it? I doubt it. Can they come back? And why would a bank want to do that? They want to just have you keep paying, right? So it's going to be status. So those properties until we get something a little bit more permanent solution for those areas. You also have California fire situation, right? And with that's already property is gone and damage is done. Can you really ultimately rebuild it? You should know that today there are structural materials that you can actually take a torch and keep it for half an hour on that material and it would not catch fire. So the ability to be able to build fire-resistant home at normal prices, the technology is there. So that's why I'm more into the build tech. But so I think what we have failed to do is that in the U.S. we have not really taken advantage of the very advanced material technology. So often enough, the zero carbon would also be attached to the same material that has the fire resistance. So I see a lot of opportunity in bringing new material, new fire resistance, and maybe ability to even deal with level of water, for example, deal with other hazards. But that's your opportunity for future new developments, right? And we are in the Bahamas, for example. There are the new resort developments all use all these solutions, right? But we're not seeing that over here.
So that's brings up another point. You brought up California. We just did an event in California last month, and one of the topics of conversation was that they believe that insurance companies will no longer insure to replacement value anymore in California. So you're not going to. So you let's say you're in construction, a fire burns through it, a hurricane knocks you down. You're not going to get replacement value. It's going to get some composition of value of the land and materials that you purchased, but you're not going to get the replacement of how far you've gone or having a building. So, what are your thoughts on that and the impact on the construction and real estate business?
So I think California is going to be a construction boom. It's going to be, but it's going to be with, I think, new technology coming in. Those homes at 5 million, 3 million, 4 million, anything under Santa Ana wind coming, those are not cheap homes. Those are the type of homes that our super jumbo mortgage would lend to, right? Or have actually in the past. So I do believe the construction technology is a lot more advanced than what is being currently used in building homes. But because of these incidents, we're going to step into those and so see much better construction. You must also know that a lot of it has to do with not just the buildings, but the plants that are around it. And whether if you actually fire starts from your home and is spread into the area, you're essentially liable. If flood starts the water goes down your property and damages another property below you, you're responsible. So I've lived there. My apartment, my first home near UCLA is in LA. So, going down there, I know I've walked every one of those. These are not new issues. It's just that the industry is working up to it. So again, I think this is an opportunity rather than worry about. There are solutions. So I think there will be.
But do you think the changes in insurance will slow down rebuilding?
No, I think what's going to happen is I think there's going to be more reinsurance. So there's going to be more spread out. So it's not one carrier doing it. So you put it in a larger property and casualty. So there are a lot of different ways to hedge yourself and still write that insurance. It's just the industry was very what I consider unsophisticated. If you remember Aon, which is like Goldman Sachs of insurance, right? I was buying catapults from them as essentially additional capital if such and such happens, right? Those structures have been around, the insurance thing stuff is, and they're going to be probably be rolled over to the investment world as an alternative investment. And we haven't heard about that for a long while. It was very big, in 2000, when you couldn't get much yield out of residential mortgage-backed securities. What do? You go into these other things to get to a double digit. Now, everybody's talking about 18%, 20% yield on equity. People were buying the properties at through treasury cap rates, right? In 2006, we're looking at ourselves, are we missing something, right? Just 2 years later, it's all disappeared, right? So I think, you need to think about where the hockey puck is going to be rather than where it is. And that's really what we do in life, right? Even though I don't play hockey.
We have another question?
Sorry, Marty, real quick, just to piggyback off your comment about California, the bigger issue, it's not so much, first of all, out of the 175 billion of estimated damage on the last fires, only 25 billion was actually insured.
Can you speak up?
Can you hear anybody here? I'll stand up.
We'll get you the microphone.
Marty, just to consider your conversation, the fires in Pacific Palisades, LA, Ron, you're familiar, was approximately $175 billion worth of damage. Only 25 billion was actually insured by state funding. So it's not so much about the construction, which is correct, because the ex-candidate to become the president, Caruso Shopping Centers, one of his centers was in the center of Pacific Palisades, but he had a perfectly built with building materials you're speaking about that were fire retardant. So that shopping center, which is a high-end, high street retail, survived the center of the fire. Everything around it burned to a crisp. But the next thing, Marty, the biggest issue in California is that the Woolsey fires that were 6 years ago in Malibu, only 40% of those homes have been rebuilt because of regulations and the issues of the inability to insure, but also to upgrade to meet the new fire standards, which people can't afford to do. So just a commentary.
Why only 25 billion?
Because all the insurance companies pulled out the last 4 years. Comment about Florida.
They were naked, essentially.
Well, Chubb,
I don't know the number, but.
Chubb pulled out, Progressive pulled out, Allstate pulled out. Allstate pulled out about $30 billion worth of insurance last year. And then what Marty, you're speaking about with California, Florida, besides the fact that the insurance companies are pulling out. Secondly, 5 years ago, when the Surfside building collapsed, the 98 people who passed away, God bless them. All the 1,400 buildings that you're talking about, the reason that they're insured is that they're actually raised capital assessment to do deferred maintenance to upgrade the buildings so they're structurally sound. And most of the people who live in those buildings, which are 30 years or older, are most people on fixed income and they can't afford it. So therefore, they're trying to sell their homes because they can't afford to have their maintenance. HOA.
Right, my understanding is that the average HOA has gone up to $100,000 over a 3-year period.
That's correct.
Florida,
That's correct.
which most people on fixed income don't have 100,000 disposable lying around.
But it's by laws. It's legislated 2 years ago. So every building that's 30 years or older has to do a full structural assessment, and a lot of people just can't afford to cover. So they're trying to sell, and there's no market for it because you can't get the insurance because most people
You can't get a mortgage.
That's correct. Thank you.
Hi, so this actually, this question is directed at this gentleman who just made the observation about the shopping center that survived. Right, so it's a commercial property. The value of a commercial property is just the present value of its income. Right, if there's no business, it's worthless. But the entire neighborhood destroyed. This thing survived. It doesn't get any insurance benefit. Yet I think it's probably become worthless because there's no business for this property. So it doesn't make sense to deploy these things.
No,
when
I'm sure
the
Los
neighborhood is at
Angeles
risk.
will rent it for homeless. They rent it to the
The homeless.
That's what happened in New York with the hotels, right?
believe me, it won't stay empty. They will find a way to
I
stay.
suspect.
Or they stick UCLA students there and residents and,
You can't house any.
oh, you haven't read the co-living concepts?
Just converted to mixed use. You got it.
The trade is wait till it defaults, then buy it on the cheap. Hopefully the neighborhood is built up by that.
Well, I mean, we got about 5-10 minutes.
Okay, great. Let's go back to a couple more. James, aside from the office, which sectors are facing the biggest challenges in 2025? Are these particular asset classes where family offices are there particular asset classes where family offices should be cautious about due to debt concerns?
I'm always cautious to sort of paint a very broad brush on what to invest in, what not to invest in, but I will try and answer the question as best I can, Jim. With regard to office, I think everyone understands, obviously, the challenges faced there. Obviously, there have been some market clearing trades, which will help bring fresh capital in. But, other property types that, are facing liquidity challenges or just kind of pretty significant risk premiums right now. In no particular order, I would say hotels, senior housing, you know, self-storage a little bit, and I'll explain why. We do like that asset class, but I think it just goes to a couple of things. One is just fundamentals, as investors are looking at perhaps excessive supply trends in the last several years, and that does impact multifamily. We're coming off a pretty robust development cycle of multifamily. It does appear to be abating. So that is something to consider. But these other property types, they do have some common features, which is sort of operational issues that are unique to them. So hotels, senior housing, these are more operational intensive businesses. I do think that investors are a little bit nervous about that. COVID has obviously had a tremendous impact on those two property types. With regard to self-storage, there is a very good story there, but that story unfortunately got played out over the last few years, where there's been significant development activity, and you may or may not realize, but self-storage properties, particularly larger ones, and the business has evolved to where they're building 1,000-bay self-storage facilities, and the lease-up requirements for these larger properties are significant. I mean, it takes years to lease these things up. So I think if investors are looking at, some of these, call it niche type properties, they just need to underwrite conservatively. And if they have conviction in the investment and the exit analysis looks solid, then, I think everything warrants sort of, consideration. But I think that there's some sort of underwriting concerns that are applicable to those property types.
The question again, I'm sorry. Was it what opportunities or what are the avoiding?
Yeah.
I'll answer my own question again. I think in terms of, I think I agree that no two real estate is the same. So the opportunity is not just location, but also price and type and situation and the income aspects of that. So I think family offices tend to be entrepreneurial and be able to analyze. And even if you're not investing, I think it was worthwhile for you to listen to some of the people who go out there and find them. I spent a lot of time with just looking at things that, half an hour of looking, you learn a few things and you move on and do it. But you keep that in mind that there is, every time you look at something, you learn something about another property that type of situation may apply. So I guess in that regard, we're almost like an AI machine. We looked at the CMBS world and learned quite a bit. I'll give you one example. In 2009, we looked at the Ritz-Carlton in Miami. Totally underwater. That property never defaulted. Why? Take a guess. Primarily because if they defaulted, the tax amount, because their base was so low, they couldn't afford to default. So the rich family owned it, they supported it, and they kept it. So that one of the assets that we have to analyze in one of the CMBS is, if you analyze it and you say, look, debt service coverage was like 0.8. That was, you should have defaulted, a year or 2 years ago. Probably because majority of the income from beverages, Ritz-Carlton property was used in part of Miami that should have been a lot more hipsters, but it was not the right fit for the brand to be there, right? You could have turned it into something and got a lot more, food and beverage out of it. And they ultimately, that was the solution. So you can't look at an asset class in what it is. You have to look at it what it's going to become. And also who owns it and why they're holding it. So that's why real estate is very interesting to us, because it tells you a lot about the history, the owner, the property, the tenants and whatnot. So, and I think, real estate, my culture, real estate investors have always been very smart and very opportunistic. So if you follow that rule, I think you will be able to also avoid, mistakes if you just don't rush yourself into and believe in something is going to happen that's not going to happen.
One more?
Oh, you got about 5 more minutes.
5 more minutes, okay, great. So if a family office is looking to deploy capital across both debt and equity, what are the most important risk-adjusted return considerations that you focus on?
Well, if you consider risk to be uncertainty or volatility, an investor then is at least hypothetically going to be looking at a credit-focused strategy. You're de-risking your investment by taking a senior secured position. I think the risk premium there is starting to compress. A couple of years ago, it was quite high as we were in the throes of a pretty significant deleveraging that nobody knew really when it was going to stop and how deep it was going to get. But if you're looking to enhance your returns, but still want to maintain, collateral coverage and, you don't want to take equity risk, then, I think sort of a layered strategy can work where, you're looking at these called subsets of credit, which even though pref equity is not considered debt, it does have some debt-like features to it. It's more equity than mezzanine, which is another form of subordinate financing. So I think that if investors are looking to, de-risk and deliver sort of more current returns, they're not as sensitive to appreciation, then you can achieve pretty strong returns. And then, that layering strategy, which I talked about, I think is quite interesting. It allows you to take controlled risk. And I think you're going to get compensated fairly for that. We'd like to talk about, we get overpaid for taking risk with our pref strategy. And I think that's very true today. So that's how I would guide family office investors, that, unless they have real strong conviction, and, are, let's say, more opportunistic, then I would continue to focus on more of a credit type strategy. But, as you see in New York, private capital, particularly opportunistic capital, has had a profound impact in the last 18 months. And that's going to continue. You've seen market clearing trades on big office buildings, some of which have traded for, I don't know, 30 cents on the dollar. But, that's part of the process where, the new capital comes in, and even if it's just simply a basis play, it does allow for a market to recover. And New York, I think, is really a proxy in a lot of ways, because, you obviously have massive players who are willing to commit substantial amounts of money to buy assets here. And then you have real strong appetite right now for conversion assets, much more than in other markets. I mean, we're looking at Chicago as a conversion market, and just the level of capital between New York and Chicago is astronomical. So New York is really kind of the proxy for whether or not, you can convert buildings on a large scale. And every other market will follow that, but really, just the amount of capital and the number of buildings that sort of fit that strategy, New York just has way more opportunities. But so it's really a combination of, if you're looking to sort of manage your risk and you want to kind of de-risk, then you stick with the credit. For those who are, looking at, outsized returns, there are, opportunistic assets to acquire.
I think I wouldn't be able to really add a whole lot to that, but I think if you're looking for opportunities, just looking at the old assets and the old strategies, it's not enough, because there's quite a bit of, we never even mentioned affordable housing. You're definitely finding that, in Southern California, Northern California. I don't know whether that's the case in Florida. I guess in Florida, when some of these properties are not insurable, that create other opportunities for building. But when I was in LA and the neighboring communities was probably 8 million. It's probably now, when you add, all the way to San Bernardino, all the way to near Palm Springs, all the way to near San Diego, you look at, probably the 5th largest country in the world. So, and these are very dense communities, and by definition, there's always, as a family office, the amount of capital you have to put to work, you have a lot of options. You don't necessarily need to have, I think, keeping your eyes open and just looking at multiple situations and picking what really fits your way of knowing and actually being closer to what you're doing rather than remotely allocating. I think, being involved in, right? That's every real estate investor that I know have succeeded have been directly involved, right? Or at least have a good sense of what they're doing. But, if you run out of things, we do have a baseball stadium somewhere that you guys can invest with a major league. So let me know about that. That could be another interesting play. Yeah. So again, there is no shortage of specialty assets that are going to come on, and you guys, I'm sure we'll find the right.
Lots of stadiums being built.
I'm sorry?
Lots of stadiums being built.
Absolutely. By the way, if you're interested in franchise loans to teams and these type of things, please call me.
Fantastic. Great job, guys. Thanks so much.
Good luck to you around.